Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking British banks, and my guest is Russ Mould, Investment Director at AJ Bell. This Thursday, the Bank of England is expected to announce a 13th consecutive rate rise, taking interest rates to a 15-year high of 4.75%. Markets are now pricing in a rise to 5.75%, within touching distance of the 6% used by the central bank to stress test major financial institutions. That means they're rushing to pull mortgage deals from the market and tighten conditions for borrowers, with average two-year rates now rising above 6% and sowing panic among those homeowners who are coming to the end of a fixed rate. But what do those higher rates mean for the banks themselves? This is the FTSE 350 Banking Index, up 9.8% year to date. That's outpacing the wider FTSE, but the picture is mixed, with Barclays almost 3% down this year and HSBC nearly 20% up, although much of that is down to the end of lockdown in China. Well, I'm joined now by Russ Mould, Investment Director at AJ Bell. Russ, hi. Thanks for joining us.
It's a pleasure.
We have to start then with the mortgage market. How much should the banks be worried that they're now going to see a wave of homeowners who are unable to meet these new, much higher repayments?
Well, I guess we'd agree they're clearly protecting themselves by withdrawing some of these mortgage products to make sure they're not unduly or excessively exposed. And I guess then what we haven't seen yet is any indication of stress so far, but now these deals are starting to roll over. The Resolution Foundation just published a report saying that the average mortgage will go up by around £2,900 per household, which out of an average UK salary of £34,000 pre-tax is a potentially very substantial hit. So there could indeed be some pressure on household cash flows, yeah, but that's partly what the Bank of England wants, I'm afraid, to calm inflation down.
For the banks, though, as you mentioned, they are pulling deals across the board. Are we going to see the supply of credit start to dry up?
It's a possibility. Again, that's one of the things the Bank of England's almost trying to achieve. And if you think about it, it's swamped the United Kingdom with cheap liquidity for the last 15 years, and now it's trying to withdraw that as best it can without then causing a drought at the same time. So it's got a very difficult balancing act. But that is partly what it's trying to achieve, is make credit more expensive, dampen demand for it, cool the economy a little bit, not hopefully too much that it tips into recession, but at the same time trying to rein in inflation.
If this cooling leads to a fall in house prices, how exposed are the banks?
Well, that will vary from bank to bank. I mean, Lloyds is clearly the UK leader. Barclays and NatWest are exposed there. Standard Chartered doesn't really care less, quite frankly, because it's an Asian bank and an emerging market bank. So you can play your exposures to the sector according to what you think may be happening and the different exposures that they have. But for Lloyds, NatWest and Barclays, yeah, some very big exposures there.
Gilt yields also at a 15-year high at the moment. Banks, of course, loaded up on them during the quantitative easing period. And we saw in the US what the spike in Treasury yields meant for some banks there. Could that play out similarly in this country?
I guess it could. You can never say never, but those banks that through the three that went down in America, particularly First Republic and Signature and SVB, they were, dare one say it, poorly run banks, and they found themselves acting as distressed sellers, which is always a terrible position in which to find yourself. There's no indication that any of the UK Big Five, or even the challengers in the 250, such as Secure Trust or OSB or Paragon or Virgin Money UK, none of them have got themselves into that similar situation. If they were forced sellers, for any reason, it would be potentially very uncomfortable for them, but no indication of that right now, no.
I know you did just say that despite all this tightening of credit, the UK might avoid a recession. But if we do go into one, how well positioned are the big five banks?
Well, again, you mentioned the stress tests earlier, and the Bank of England has applied very rigorous stress tests, whereas those banks in the US that went down, much looser requirements. In fact, deregulation under President Trump probably sowed the seeds of their demise, whereas the big banks here in the UK regularly checked for all kinds of very severe outcomes. So in theory, with their common equity tier 1 ratios, their leverage ratios, they pass all the tests, is what I can say, and they are already saying to their shareholders, we will see an increase in bad loans in 2023. A more normal level is what they're saying, something between 0.3 and 0.5% of the loan book, up from unheard of lows previously. So they are already warning of that, and it's already factored into analyst estimates.
How should shareholders be approaching the banks?
Well, I think they've clearly been approaching them with extreme caution, because, as you said, they've moderately outperformed the index, but that's all down to HSBC and Standard Chartered because of Asia. The British-focused ones, Barclays, NatWest, Lloyds, haven't done anything and have basically paddled sideways for some considerable period of time. So what you do have is Barclays trading at half times book value, partly because of the drought that's facing the investment banking business in terms of deals right now. Lloyds and NatWest near a book value and offering quite a fat yield. So there's value to be had there. It's just a matter of how patient and brave, dare one say, you're probably prepared to be.
You mentioned they've been quite cautious in the guidance they've given to shareholders. Do you think this will turn out to have been overcautious?
I think nobody really was necessarily expecting interest rates to rocket up to anywhere near 6% as quickly as they have, even if the Bank of England is widely acknowledged to have bungled it with what we're calling inflation transitory. So I think that has been an unpleasant surprise for everybody. In that respect, you could argue the banks have hung in relatively tough, given that they're unchanged almost as a sector. And that, again, is, I think, the product of the valuations they offer, the apparent financial strength that they offer, and those dividend yields that they offer, which in some cases supplemented by share buybacks as well.
Russ Mould, Investment Director at AJ Bell, thanks so much for joining us. And that's your roundup of the UK banking sector. I'm Elena Casas, and this is Reuters.